So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys? And welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I'm joined today by Joe Robert. Joe has over 20 years of experience in alternative asset management, including real estate, startups, and cryptocurrency. He currently serves as CEO of Robert Ventures, which offers clients returns through their portfolios. He believes we are in the beginning stages of the transition to a digital economy. In the next 10 years will challenge everything we think we know about investing, finance, and wealth management. Joe, welcome to the show.
Jonny, thank you for having me.
Stoked to have you. We got a lot to get to, and you've obviously got a very solid resume here. Take us back, though. I know you kind of mentioned offline, you started when you were 19. Kind of give us a Reader's Digest version of, kind of what led you to where you're at now.
Well, I think one of those things that I like to look back and say I was kind of always a contrarian, right? So when I was younger, I was a little different than my siblings. I always wanted to go out, make that extra money, take care of my own bills, be independent, right? One of the things when I turned 16 was, hey, I need to pay for my own car. I need to pay for my own car insurance. This way my parents can't have control over it, right? Where most people at that point, they always paid for everything, but I took the other view, So my early teenage years, I was doing landscaping, and then my junior and senior year of high school, I obviously, like most probably, well, not most, but most like myself, didn't want to be in class all day long, right? And so one way to exit out of there was to go to the tech school across the street for construction. So I was able to get out about half a day. And so that kind of, in a sense, almost kind of started the career, right? So getting out of high school, I had a company called JR's Contracting and Landscaping. I was doing work on both contracting and landscaping, but ultimately started dropping landscaping, going more the contracting route. So then that led me to, find a piece of property there at the age of 19, my first piece of real estate to purchase. And, it was a couple 100-year-old farmhouse. I advise no one to start with that because, you, you learn a lot of lessons, right?
Yeah, some have to be learned the hard way.
Yeah. So, but you know what? It was great because actually, it had an outbuilding. What I did was I converted that into a apartment. I moved into the apartment and then I remodeled the house and then moved into the house. Ultimately, I sold after the 2-year mark as a primary residence and got those tax benefits. And that kind of started the real estate career. But as you can see, kind of that contracting, then went over to do the real estate. I was doing the work. And so now we're in the 2000s. My mom was doing some investing down in the Outer Banks. I was from the Philadelphia area, but we go down there on vacation every year. And so I was doing some real estate, I guess, besides her, buying some properties, fixing them up, along with some small lot subdivisions. And, the crash came, right? Everyone was investing in the 2000s. It was affected by the crash in some capacity. So that kind of put a stop to that. And, after that, about 2000, maybe 10-ish, I picked back up, buying real estate in the Philadelphia area locally. And from there, I, was acquiring rehabs and still doing the work. And then finally, I was like, okay, I can't really scale if I'm doing all the work, right? Does that make sense?
Yeah, absolutely.
And so I decided kind of to sell all my tools. Sell all my tools and truck, right? It forces you to move forward in life. So sometimes if you're struggling to move forward, you kind of got to get rid of whatever's that distraction.
Burn the ships.
Correct. And so I got rid of the tools. It was one property that was in the process that my private lender said he was going to move his money from me over to another company. And I was paying him 15% at that time. And he was like, wow. I was like, what are you getting? He's like 18%, which these days it probably sounds crazy, but maybe 10 years ago when the opportunity was kind of there, you had the ability to be able to afford those returns to those passive investors. So I found out he was investing in a company that was buying distressed second mortgages, a lot of the HELOCs, the piggybacks that were originating in the 2000s, the subprime stuff. So it's very interesting because most people would approach that as a very risky investment. What do you think of that?
Yeah, I mean, I'm not risk averse, right? I mean, here I am. We're both entrepreneurs, right? I think but I certainly can see why people would think that's very risky. But ultimately, for me, that's the kind of speculation I like to have in some portion of my portfolio.
Yeah, so I started attending some local meetings there. And I just got to understand the space. And after being through the 2000s, I just at that moment thought it really would be cool as hell to be on the other side of the transaction and actually own the debt versus owe the debt to people or the banks, right? So I bought a initial pool of loans. I hired a friend at that time to do the work for me to kind of validate the idea before I kind of, shifted more focus from the rehabs over to the debt side. And it was about 6, 8 months in that I recovered 100% of my initial principal and kind of validated quickly that, the ability to move forward was there. Um, so I partnered with him and another person, and we kind of formed a mortgage debt buying company, and we started buying debt there. That was probably about 2011-ish, like I said, 2012. And for the next couple of years, we were buying pools of loans. We built out office there in the suburbs. Um, and then 2014, I decided, hey, I need somewhere a little bit warmer than the Northeast. And is there anything better from a tax environment? So I spoke to my security attorney. I said, hey, is any of this tax thing legitimate, right? This is like back, I think, when Obama was talking about cracking down these places and everything. He's like, as long as you're a legal resident, right? He's like, I heard of something about Puerto Rico, but I'm not familiar. And from there, I went home, Googled like anybody would, and ended up down there a few months later, booked an apartment and moved down there. So my one partner moved down, so it was the two of us, and you know, that started our Puerto Rico journey.
Wow, that's wild. So you've really done it all, kind of experienced all of it. You've now honed in on what is working and what you want to stick to. So what have you identified there in terms of, what's working moving forward for Robert Ventures?
Well, I guess one concept I like to think of that I'm learning myself, and I think we're always learning. People always discuss if there's a right time to sell, should you hold forever, and all these different things, right? And so I think time in market is important, but also timing the market is important, right? So I think the more time in in the market, you could create greater wealth, but you also don't want to be too late, right? So that's where the part of time in the market is. I mean, once you understand something is fair or value has gone way past fair value, you should be willing to take some chips off the table. So what has worked and hasn't worked in the past is obviously the time in which I bought. So over the last decade, buying in a lot of the 2010, 11 to 2016 range, and then selling in the last couple of years has worked well. So I think that's a lot of the philosophy I hold now is kind of to look a little bit of the cycles and also forecast where are things going in the next 5 to 10 years, and then try to make investment decisions off of that and not just standard cookie cutter decisions.
That's awesome. I love it. Yeah, and that's what's so great as you get more experience, right? And as you're able to use historical data, you can start to understand the cycles, where we're at, what's coming next, and kind of, you're not always going to time it perfectly, right? But at least have a better idea of, what's coming and where we're at. So of that, obviously, we now know that the peak of the market was pretty much kind of Q1 of this year, and we're now trending downward. So using what where would you say we're at, and what's kind of coming? We'll start with just the next 12 to 18 months, and then we'll kind of move forward from there.
Yeah, based on today's opinion, right? Subject to change every quarter or every Fed announcement.
Right. Honestly, probably going to change in another month here with the next Fed. So we'll
You,
see.
being more of a historically being more of a distressed, asset buyer, right? I was kind of celebrating when COVID hit in this extent that we thought we were already kind of seeing peak values and that we should see opportunity soon. That didn't happen. Now, this time around, it seems like the Fed is more aggressive and more sticking to their plan. Um, so I kind of said back towards the beginning of the year, a few different things that stick out that I mentioned. Some people I know is like, listen, I've learned over time that when everyone's on the same side of the trade, the party's going to end soon, right? And when you see conference rooms packed on multifamily syndication like they have in the last 24 months, and you see the valuations people are paying for, you know at some point it's coming to an end. Um, there's a lot of people that have been yelling out supply and demand. There's just not enough supply, not enough supply, not enough houses, right? I was like, okay, they said similar things in 2000s in that crash, right? They started building inland Florida. They started building all these areas because there's demand. There was demand because of the mortgages that they were giving out. This time around, there's demand because of the low interest rates they were giving out, right? So what happens when that economy changes? Now we are starting to see that, right? Less demand. So now all of a sudden, are we really in a supply problem? Um, I said at the beginning of the year, I at least think about a 20% correction. You know, everything is geographic related, meaning I think areas that have gone up the most, for the most part, will correct the most, and some of the areas that were probably had the least increase in prices may not go down, 20%. Um, we'll correct some back to some mean, probably a little bit higher than pre-COVID, but somewhere in that gap, depending on the city and how much that price increased. Um, as
Yeah.
now I'm kind of thinking that there's for the next 5 years in real estate, it's not, besides going, down or a decrease, it's going to kind of be flat and there's not going to be as much activity. I don't think people should be thinking about what's occurred in the last 24 months and think that is normal.
Could not agree more. Yeah, you pretty much just summed up my exact uh, kind of theory as well, right? Because this is not a blanket crash, like you said, right? There's some markets are going to be more insulated just because because of COVID, there was a huge shift in where people are living, what markets, are seeing stronger economics than others. Some of those I think are going to experience real corrections, like you said. I think Austin is due for one, but like you said, they went so high that, of course, relatively speaking, it's going to look like a crash.
Yeah.
When really all it is just a bigger correction because they just went up higher, right?
Correct, though. Yes,
Yeah,
I can't agree more. That is the case. You know, there's a lot of migration, net migration, and based on the remote work, right? That conversation has happened over the last 24 months. And you could definitely see a case for where maybe even a lot of people that over the next 5 years were like, oh, I'm going to move to Florida, say, for example. They're like, okay, COVID's locked down. Like, I'm up in Northeast. Let's just make the move now.
yep,
So I think we could have possibly also front loaded some of that migration over the next few years. And I
100%.
think as more, not saying all the remote work's going back, but a certain small percent of remote workers will go back to the office. There's that aspect. And then I also think there's a portion that did make that move and they found out the grass wasn't greener. And then they want to head back to where their family lives and so forth. So I think there's going to be some pressures on those places. Take Florida, for example, that have gone up so much and then have had this story between remote work, jobs, and everything. And I think that'll kind of revert back in some capacity.
Yeah, I completely agree. And even like sort of the random tertiary places like, you know, like Bozeman and Boise
Yeah.
and some of these like smaller places that just kind of exploded. Now that the country's back open, people are like, do I really want to live in Boise, Idaho? Or would I rather go back to LA and live in LA now that it's open again? And I think it's the latter. I think some of these places, the appeal was there when things were closed down and there was nothing to do anyway. And so it's like, yeah, I'm just going to go explore this beautiful area, because it's not like I can go be socializing. And now that you can socialize again, these places aren't the most conducive for that lifestyle. So they're going to go back to the big cities.
Yeah. So I think from a real estate front, I mean, I don't think there's going to be much in regards to price increases and much action in the next 5 years. I mean, I just think, a lot of times it's 10, 15-year cycles, right? Plus, and I just think based on this growth that we've seen, that's going to take a while to correct and kind of work through the system.
Yeah, it's going to be slow, kind of a slow bleed.
Yeah.
The Fed has obviously indicated they're going to do two more rate hikes this year. I really think they're just trying to just hit the stop button, slow things down as quick as possible, let supply catch up. I do think we're still undersupplied, but I do think in the next 5 years that will, change. I mean, you're still, you know, development has slowed, but you're still seeing a lot of development. Projects that were already under construction obviously are going to be finished. A big indicator is there's still cranes all over. Like I'm in Salt Lake City, there's still cranes up, stuff being built. But I think that when everything smooths out, I think the new normal will be somewhere in that 4 to 7% interest rate range. What do you kind of think in terms of the new norm?
Yeah, I definitely agree. You said 4 to 6, 4 to 6.5,
Yeah.
5 to 6.5. I think that's somewhere in the ballpark. Could we go up more from here? I think, effectively what happened is the government printed trillions, created supply chain problems, and we'll call it inflation, drove up prices, and now that everything got out of control, they want to take it back. They've taken back we'll call it the stock market. Most markets where it trades freely, there's liquidity there, and they could do that quickly. Where real estate, that usually takes a few years. Now they see the entry level home median price and realize that most Americans can't afford that too, and they got to rein this back in. So essentially, they'll bring prices back, maybe not the COVID price, but somewhere near-ish, depending on the location. But yet we're sitting there with probably the trillion still owed back as debt. Printed it, caused problems. Now trying to rein back in the problems, but still owe the debt. I'm like, this doesn't.
Well, if it isn't the consequences of my own actions, who would have thought? I can't believe it. No way. Crazy how that works, right?
It
Now
is.
they're
It
like,
is.
oh, maybe we should fix that. You mean we gave people all this money and everything went up and now they can't afford it, even with all the money they were given?
Yeah, so
Psych.
that'll be interesting because I think, obviously with the higher interest rates, the entry level or no, affordability across the board is going to struggle, right? And so ultimately something's going to have to give, right? It's like wages, interest rates, and pricing, and it's probably all of them in some combination.
I agree. It'll be all of them. I think that, seller sentiment hasn't still quite caught up. Like you mentioned a little bit earlier, right? The last 2 years is not the norm. And I think that sellers and investors alike, which, not mutually exclusive, but, I think that some investors definitely came into the investment world because of equity that they had and gained, right? Had never really had anything like that, access to capital like that, decided to start investing. And I think that, that sentiment needs to change, and that, you're not going to get, 14 to 18 month deals that 2x your money. You're going to have to get used to your 3 to 5 to 7 year holds again. And, sellers are going to have to come back down to earth, and that, it's not a blank check. You can't just name a price and still get 20% higher than that. And so I think once all of that comes, which will be slow, right? Real estate, like you said, does take longer. It's not as liquid as stock and crypto, so it takes longer. So I think by Q2 of next year, I really think you'll start to see some real shifts downward in all of those numbers.
Yeah, I mean, that makes sense. I mean, if the Fed does a couple more hikes here in we'll call it Q4, right? We're getting out of that. That'll put us like 6 to 9 months past the peak where we call it the seller denial phase, right? And they initially reject some offers because it was below their asking, and then they go back later and reduce it less than that initial price because they didn't take that first offer. And then, like you said, probably Q2 next year, I think people will be into reality of what's actually happening in the real estate world and where it's going.
Yep. Yeah, absolutely. And it'll be, that's when I think by middle of next year, that's when you're going to start to see some opportunities start to rise. But, again, I'm not an economist, so this is just based on, talking to people, like yourselves, and just what I see, right? I mean, like you said, you go to these conferences, it's loaded with people, in the multifamily world, and you're like, there's no way this, like, I do know, one thing I love about this industry is the abundance mindset, right? Everybody wants to help everybody, but there's just no way that all of these people can acquire and really hit the numbers that they think they're going to hit, right? And so you'll start to see, I don't necessarily think you'll see distressed assets like you saw in, after 08, but I think you'll see distressed operators where, because of these bridge loans and some of this debt that they got, this 2 and 3 year interest only debt that they've got, even with their rate caps, I think that you'll see some of these where they can't sustain the new interest rates, and you'll see some of these assets go trade lower than what they normally would.
Yeah, I mean, it's really gonna, and obviously, rank growth or or decline, however you want to look at that, will have a big impact. So, depending on where that property is located, I think people have been so bullish on rents going up and just, I think, have this mindset next decade rents are going to just keep going up and up and up. I definitely don't agree with that. I mean, obviously, city by city, but I think, definitely some places could see declines in the next few years.
Absolutely. Absolutely. And it's the ones that shot up, right? Where it's just like it naturally has to happen. What goes up must come down. We go in cycles. So you mentioned earlier that, you're working on a new fund. But you're also kind of waiting. So what does the next 12 to 18 months look like for you guys specifically in terms of, asset allocation and all of that?
Yeah, so just take a step back. What I'll do is, about while I was in Puerto Rico in 2017, most people that are moving down there are entrepreneur-like because they're moving down there for the weather, but also the tax benefits that Puerto Rico is offering to entrepreneurs. And I got to meet people on the tech side, crypto side, blockchain side. Um, you know, Growing up not having a computer per se, right? And kind of just being in real estate, it was kind of intriguing again to understand, where the world is going, because everywhere you turn around is technology, right? Now, these days, it's Zoom, it's your phone, this is kind of how things are going to work. So I believe as a whole, the economy is moving to a digital economy, right? I mean, even these multifamily buildings, I don't know how long, call it 20 years out, 30 years out. I mean, I'm sure a percentage of them will be traded on algorithms,
Absolutely.
where
1000%.
it could pull up historical, property reports, think like Carfax, right? Where you could put this stuff where, historical reports are uploaded and then, algorithms can, read all the data and trade assets. So thinking of that, kind of led me down to trial, investing in the blockchain space there. And so that was the fall of 2017. And now since then, we made investments in a liquid crypto portfolio, a lot of other funds in the space we built relationships with, that kind of expands our expertise. And so now, moving forward, what we're looking to do is build a hybrid fund where we're going to offer a fixed rate of 8 and 10%, depending on if you're locked in for 12 or 36 months. And we're going to have a real estate allocation, a equity allocation, and a digital asset allocation. We believe that obviously from a real estate standpoint, from a risk standpoint, that's great to have some real estate in your portfolio. I have that relationship for the last 20 years. So we have access to deals as they come along. And from the technology side, I'm looking out the next 10 years. I believe that this sector will way outperform the real estate sector, right? And so that's how we're looking to allocate the next 12 to 18 months. Most, but not all, a lot of the private company valuations have been coming down over the last 6 months since the stock market sold off. And like I mentioned, a lot of stocks have already sold off. I think in the next 6 to 12 months, we'll see a floor there. If we haven't seen a floor, maybe we get another leg down or so, but I think we're seeing a floor. And yeah, so we're going to be looking to make allocations there. And then, like you said, into next year, probably more Q2 to Q4, depending on the market, hopefully we'll start seeing some of those real estate opportunities that we can start adding into the portfolio there.
That's awesome. I love it. And are you, in terms of real estate, are you primarily looking at residential, small multifamily, large multifamily, everything in between?
So most of the stuff we've done in the past has been, I would say probably let's call it 80% real residential, 20% commercial. On the commercial stuff, mostly small balance in the few hundred K to a couple $1 million. Typically the deals we do are more in the a few hundred K to $5 million range, smaller deals, but higher yield, higher projection. That's typically where we look at moving forward. If the opportunity from a scale standpoint, capital raising, I think we're going to have to, increase deal size and probably look to more commercial in the future than on the residential side. and just from a
Yeah,
management standpoint too.
yeah, absolutely. I mean, you nailed it, right? Scalability, especially when you're talking about a fund, that eventually just has to lead to multifamily. Just makes the infrastructure can only go so far if you're just building this massive residential portfolio where you get spread too thin management, like you said, um, and just being able to be nimble and move between properties.
And occasionally we also will partner with great, we don't have to be they'll call it the GP or the actual operator on every deal. I do partner
Right.
with people that I build a relationship with or invest in some of their deals. So we kind of have a combination that allows us to kind of cherry pick, what we think can hit our internal hurdles.
Absolutely. That's what I love about this industry is there's always partnership opportunities with someone who, you know, maybe has, better deal flow in specifically in a certain asset class or certain market where you can just be like, hey, you know, I can bring, X value, right? Typically it's going to be capital, especially in the way of a fund, typically going to bring capital, but also you obviously have the experience as well and all of that. So,
Yeah, so like just for the listeners here, so to kind of break that down, like let's just say you do your internal team does research and your thesis so in the next 5 to 7 years, RV parks are going to boom because the RV sales are continuing to increase and there's this, movement for remote workers. And maybe some of these parks are going to be able to house, call it short-term to long-term people that want to actually stay longer. If you're not kind of the expert in that sector, maybe best for you to go seek those people that are already building that product and become limited partners, but maybe become more substantial limited partners where you get a percentage of that GP and more upside.
yep, absolutely. I love it. Well, Joe, this has been incredible. Loved all of your insight. Obviously, love talking economics. Huge, huge buff there, especially in these times, because it's fun to play the prediction game. It's like, what do you think is going to happen? If you're right, like I'm definitely going to be chiming in here in 6 months. Like I told you, I muted myself, or I'm going to say I could have not been more wrong. Not afraid to admit that either. So
I mean, look, we were wrong at COVID because obviously we
yes,
all thought things were going to hit the gutter, right? And that the Fed changed that, so we don't know the future. And I like to say is, listen, all investing is speculation. Why do I say that? Because you're speculating on what's going to happen in the future, and you have no control and no way of knowing that outcome. It's just a matter of what type of risk is on each asset class, right? But like
correct.
you said, you can invest in multifamily today in 10 years make like no money or no appreciation. It's possible. We don't know exactly where the market it goes. We try to take the data and make the best decisions.
Yep. Absolutely. And when it comes to crypto, especially, that's what I tell people, and I'm newer to the space. Like I was a stockbroker, so that's something I know really well. Obviously, getting very deep into real estate now, kind of also trying to learn crypto. And I just tell people, like how I would vet a sponsor or vet a deal, I'll vet your crypto and your stock investments as well, right? Some coins going to zero now, so just be weary of which projects and why that project. Maybe understanding why that's a strong coin or a strong crypto asset as opposed to just some guy on Instagram is trying to
On
it's
Twitter
trying to
pumping.
pump and dump you.
Yeah, I mean, like the saying goes like this, and you unfortunately, for majority of us, also listening and myself, you got to kind of go through the pain in order to learn in life. But the more outsized the returns that you see on any type of project, asset, crypto, typically the less likely that's going to work out in your favor to hit that mark. So, take that, do with what you want, but you should definitely keep that in the back of your mind.
Absolutely. I love that. Cool. Well, let's go ahead and wind down here. We'll jump to the final five. First question, best advice you've gotten from a mentor?
I would say, one that I've gotten, don't over leverage without cash flow that can service that debt. I mean, that's really kind of why most people always blow up.
Yep. Yep. Couldn't agree more. What is it about your career that makes you feel like you're fulfilling your why?
What is about my career that makes me feel like I'm fulfilling my why? Well, I would say because shit, I'm just having fun every day. You know what I mean? And my why is kind of like as long as I'm having fun, enjoying myself, having fun with family, friends, and the people through business, then I must be doing something right in my daily life.
Absolutely. I love it. Favorite non-real estate or investment related book?
Definitely not a book man. Definitely not a book man. I would like to say I'll counter that with I'm definitely more of a YouTube person, right? And I like to tune into people to solve problems for what I'm trying to solve at that point. Even just understanding right now, like if you listen to All In Pod, some of the Shamoth and billionaires, understanding, taking their words and understanding what they're doing in the market. Like, are they starting to nibble? Are they selling? And just kind of analyze this and be able to use that data to make actions in your business.
I love it. That's awesome. If you could have any superpower, what would it be?
Shit, I probably would want to live longer. I mean, is that a superpower?
Absolutely. I hope
Superpower.
so.
If not, maybe be able to sleep less without needing that full body recovery, so I could have more time in my life, one way or the other,
Gosh,
I guess.
that would be nice. Both of those. Either way, you're trying to add time. I love it. That's absolutely a huge one. Cool. Last one. What's the best way for people to get a hold of you and learn more?
Yeah, best way, obviously, you can find Joe, Robert across most social media platforms. You can search me there, drop me a message. Otherwise, if you're any interested in kind of digital assets, you can go to joerobert.com. Last, if you want more information about our fund that we're launching here in the next week or two on a fixed rate fund, you could book a call with me personally if you're accredited at robertventures.com. And yeah, Johnny, I appreciate having me on today, and hopefully the listeners enjoyed our episode.
Absolutely. Yeah, I appreciate all the value that you brought. I know they'll get a lot out of it. We'll link those links in the show notes, make it super easy for everyone. Joe, thank you so much.
Thank you.
Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.